You're dialed in to the retirement income source where it's all about increasing your income. That is correct. Most people are leaving money on the table. And increasing your income can inhibit a lot of risk out there, which is what we're going to be talking a lot about today. I'm Tim Sparks, and our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky. This show is for you, the listener. What I teach you here today is based on experience of what to do and what not to do, what I've learned in 19 years. Whether you're a pre-retiree who wants to get it right or a retiree who wants the retirement to end well, all I can say is you have to be diligent. What I have found is a lot of people have a tendency to get in the back seat of a taxi cab and let somebody just drive them around through retirement, their financial advisor, or even it's a set it, forget it type portfolio because they just are thinking the markets are always going to go up, whatever it may be. And to be quite honest with you, though, that's kind of like sticking your head in the sand and ignoring a lot of risk. You see, you're on your own. We're in the yo-yo economy. You need to get informed and most importantly learn how money works and what you need to do to understand that accumulating wealth was easy. It was child's play compared to knowing how to maintain your wealth while simultaneously getting income. And today we're going to be talking about 4 key risks not to ignore. And these were actually a white paper I read many years ago regarding these 4 risks that I think that actually set the tone for my philosophy of helping people to get through retirement, and that is invest for income. You see, the 4 risk has a lot to do with looking at the past. And currently is the present, right? And the future, unfortunately, is the unknown. So we have to be aware that the future, if you don't know what it's going to do, the question is you need to prepare in a way, in the bird in the hand approach way, so that way in case things don't actually occur exactly the way you hoped and anticipated, at least you can still get your income, because that's the most important thing what most people need in retirement in the first place, because you need to replace that income that you were working for at one time before you transition into retirement, and you really don't want that income to change. So we got to make sure we're aware that the future has nothing to do with the past. And if you plan based on the past, well, believe it or not, if that was the way the plans were actually going to be laid out going forward, then I wouldn't have no reason to say that. Unfortunately, the markets always repeat themselves one way or the other, and we know they go up, sideways, or down. I'm not as concerned about going up. I'm more concerned about what if they go down. And so, yes, I'm not being a pessimist. It's just I have worked with people that actually have experienced down markets while taking income, and actually their retirements are basically ruined, where they had to make a lot of changes meaning reducing their income. Some had to go back to work, and others just threw caution to the wind and just took money out knowing that their balance was going down. And so you don't want to be a victim as the markets go down. So our philosophy is about investing for income is exactly what large corporations and institutions do. It's people like Warren Buffett and Ben Graham do. I mean, if you think about it for a moment, what do you think catapulted his wealth in the first place? And matter of fact, he still holds the same holdings today. Why? Because investing for income, if you own and accumulate a bunch of shares of a particular company, and if your dividends are reinvesting and buying more shares, you're organically going up in value. That's one way of looking at it. Another way is if you need income and you're trying to outpace inflation. You can do that by holding on your shares, which fluctuate in price value, and all you have to do is just take the income they're paid to you on a per share share basis. That's the reason why income doesn't change whenever the markets fluctuate. You see, when you go into retirement, you only get one chance to get it right. And you want to have things that favor you when you're in retirement. I mean, if I had $1 million, and just go along with me for a moment here. Let's just say I have $1 million, and I've got it invested in interest and dividends. They're coming from specific bonds and stocks that's customized for you, totally diversified, and you're generating, let's just say, $50,000 a year in additional income. Now, keep in mind, your $1 million, when it goes out, and when we go out and we invest that money in shares, we buy all these shares, and all these shares come up to a current income of $50,000. Now, if you take that $50,000 and just put it in your bank account and don't spend it, I'm just trying to help you to get the vision of this. If you don't spend it for 10 years, and let's just say that income maintains the course for 10 straight years, that's $500,000 in income that's coming to you, while at the same time you still got your $1 million invested. That money didn't come from principal from your $1 million. It went in there because of what you had it invested in. It went into your bank account, so now you have $500,000. I don't know about you, but that is a great plan to have. Why? Because when I go into retirement, I've got to have income. And most people are spending 4 to 5% of their portfolio each and every year. The reason why I want to invest for income, and I believe in investing for income, that's our philosophy, is invest for income, is because I want to keep my $1 million intact. So if you would like to know more about what I mean by investing for income, in other words, how do you get income in excess of 45 or 50,000 a year, just kind of in that little analogy that I just now illustrated, I want to get a commission report in your hand to understand the formula of total return equals I plus G. And this is a commission report that we actually put together to help people to understand what we mean by this formula and why it can help you to be successful in retirement, especially when it comes to income, a problem that you have to fix. And if you call 888-930-1080, again, that's 888-930-1080, we will mail this to you or email it to you, whichever you prefer. Again, that number is 888-930-1080. This commission report will actually help you to be able to identify what we mean by investing for income. In other words, being eye-focused when you're going into retirement, because you're trying to solve a problem. The problem is you need to spend income. If you're going to get income, you might as well get it from the I, not the G. And this report will help you to be able to know the distinct difference between the two. And most importantly, as we go through the 4 risks today that you cannot ignore, this same formula is what will help our clients to get through these certain risks, because at the end of the day, you're trying to increase your batting average. You increase your batting average by investing in income that's already going to be paid to you, because it's not that we're taking people out of the market and we're coming up with these new ideas and new investment instruments that nobody's ever heard of. Just because I'm talking about individual stocks and individual bonds that pay interest and dividends doesn't mean it's too good to be true. This stuff has been around for a long time. Did you know I went back and I did some research on bonds and how long they've been paying yield? Did you know it goes all the way back to the 1600s? Did you know the oldest stock that paid dividends is over 200 years old? So, if I don't know. Sometimes I've had people tell me, this is just too good to be true, and I don't know where they're getting that information at, because all they have to do is just do a little research. If we just want to, as my dad used to call it, the hype of ignorance, if we just want to ignore something and just say no to it just because we don't want to further investigate it, then you're correct. Then you won't know, and you won't never know whether it's true or not. And, my dad always told me, if you found out something to be true, when you want to know about it. Well, I can tell you right now, increasing somebody's income in retirement, which is something they need in the first place, $40,000 or $50,000, which is 3 to 4 times more than what I'm seeing in portfolios today, that's coming automatically to you regardless of what the markets do. And we're going forward, we need a return. And if we need a return, we need a return that can provide that income. And so, how do you want your income? Do you want it to be more reliable, or do you want it to be unreliable? Do you want a retirement that's going to be a hope and a prayer portfolio? I mean, it's really totally up to you. I mean, I'm not saying that the markets don't, that the markets won't go up. There are times that the markets go up, and over time they do go up. And I'm not a pessimist, because I'm a firm believer that the markets over time do go up in value. But what we're talking about, what goes up in value, is capital appreciation. Just like if you paid $100,000 for a house 20 years ago, that house is probably worth $250,000 or $300,000 today. That's appreciation. But if you want to be able to realize that appreciation, you have to sell the house to get that. Well, what we're talking about, if you've got $1 million of money invested, it's going to go up in value if you can just collect enough rent from that house, if you will, and you do that with stocks and bonds. And so if you can take that kind of income from those stocks and bonds and deposit that into your bank each and every month, you're going to have a more stress-free of a retirement than other people that are actually not getting enough income. They're getting much lesser income, and they're hoping that the markets will recover the loss of principal that they just spent because they had to withdraw principal in the first place to come up with the same income. So if you want to learn about income first methods versus growth methods should be second. In other words, if you want income, you're going to get growth. But if you want growth, you won't always get income. I got an excellent book called Return on Principal, authored by CFA Dave Scranton. You see, when you have a strategy geared toward interest and dividends, you always know how much income you're going to be getting. So now it doesn't really matter if the markets really go up or down. This is what you will learn. That way, if there is market fluctuations, you don't have to worry about increasing your stress levels. Now you're knowing your income is coming from the I model and not from the growth model where you're having to spend principal. And I got a free copy for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail this out to you if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. You're tuned in to the Retirement Income Source with Tim Sparks. We'll be right back. Welcome to the Retirement Income Source with Tim Sparks, your host, sponsored by Sparks Financial Group, a firm right here in the heart of the Bluegrass, Lexington, Kentucky. Today, we're going to be talking about the 4 risks that you can't ignore, or you hope you're prepared for. And if you're not, then you need to find somebody that specializes in helping you to overcome these particular 4 risks. Those risks are, simply put, a sequence of equity risk. In other words, when you step into retirement, if you're one of those that are pre-retiree going into retirement, you don't know whether the markets are going to go in a downward trend or in an upward trend. Believe it or not, you don't. If they go in an upward trend, and if they do that consistently for 8 or 10 years, it's almost a fact, depending on how much losses you can get into the future, that you will more than likely not outlive your money. That's assuming the markets go up. But if the markets go the other direction, or if there's a pattern of 2 or 3 or 4 years, or a recession early on, then the chances of you running out of money in 15 to 20 years is highly likely. So in other words, sequence of equity risk is extremely important. So in other words, you want to be able to mitigate that risk. So it's not all in equities. When I say equities, I'm talking about stocks primarily. But there's another risk that people don't. And by the way, this report, this white paper that I've actually read and I'm sharing with you, was written by academians. These are people that are in the top of their game. These are professors that teaches in schools or for as far as master's degrees in financial planning and so forth. And so this particular gentleman I'm talking about, Wade Fowle, was talking about these 4 types of risks. Equity risk being one. If you have a sequence of equities going down, then you have a problem. If you have also a sequence of bond risk. In other words, see, bond yields in the last 15 to 20 years have actually went down in value, income-wise, and so therefore, if yield continues to be decreased, even though you have bond funds in your portfolio or bond ETFs, it doesn't really matter. Bond ETFs get slightly a little bit more edge on income, and that's about it. The amount of yield that an average bond fund or ETF today is right around 3%. And the only reason we're getting that kind of yield right now on those type of instruments is because the market interest rates went up in the last couple years. If you look back just a couple years prior, whenever this white paper was created, the bond yields were averaging in these particular funds on average around 2.25%, 2.5%. So they were even lower. And that's what the report was saying, is we have inconsistency with bond yields. And what they were examining was the tools that people are primarily using when they're in retirement. So whenever they did the white paper, they want to examine the tools that people primarily are using in retirement. And the reason people use bond funds or bond ETFs is because they're trying to reduce their risk. That's it. But they're really not focusing on the income component of that particular instrument, because bonds typically pay yield. And 2.5% or 3% on average. By the way, people, I'm not even factoring in if you have a financial advisor is charging fee, it may be even less that you're getting paid. And so what they're saying is if that fluctuation of that yield, which is what you will get, you can't depend on it, will always be like that. And over time, you still see values decrease in bond funds or bond ETFs, like we've seen the last couple of years. Heck, they're still down at least 10% on average right now. So if you were taking withdrawals during that time, you were taking withdrawals in a kind of a discounted time right now. I mean, so because your interest that you were earning on these instruments was not enough, and so what they said, since most people use these things to reduce risk, you put bond funds in your portfolio to reduce risk. That way you don't get hit so hard with stocks. So you want that balance, and that's the reason why people use those tools. I'm here to say that those tools are not the same thing as actual bonds or bond-like instruments. First of all, if you want to get a pay raise, use individual bonds, for example, because individual bonds right now are paying about 2%, 2.5% more than what you're going to get in a bond fund. Not only that, contractually speaking, you're going to get your money back where you do not get your money back in an actual bond fund. So sequence of bond fund risk is extremely important. The other risk is the sequence of inflation. If we run into a pattern of inflation, of course we are in high inflationary times right now. We've only seen about 2.5 years worth of high inflation, but the last time we had inflation at these numbers was back in 1966 to 1982. So what they were saying in this report is, what if we have a sequence of higher inflation? Well, again, the only reason I'm bringing this up is because we are experiencing that right now. So if you have $100,000 and you're taking out $4,000, let's just say you're taking out 4%, and you need $4,000 from that vehicle, then if you look at inflationary numbers in the last 2.5 years, it's up 20%. So if what you were paying $4,000 for just 2.5 years ago is only buying $3,200 worth of goods today. That's how quick inflation can impact cash flow, which means if you need $4,000, means you have to increase your income by 20% to be able to keep up with the goods and services. And inflation, we all heard it. It's like blood pressure. It kind of comes unnoticed. But I can tell you, even my own experience working with people, even with my own bills and everything I have to pay, we know inflation is a real number. So if this makes sense to you, I want to get a commission report in your hand on helping you to understand the distinction between bonds versus bond funds. And this commission report can be yours. It's a simple read. If you call 888-930-1080, again, that's 888-930-1080, and we can email this to you or mail it, whichever you prefer. Again, that's 888-930-1080. Bond versus bond funds. In other words, contractually speaking, plus might as well go ahead and increase your income at the same time. Now, if you're concerned about how to actually get bonds and you don't know if you've got the experience or the knowledge to be able to buy bonds, then you need to seek out an income specialist that actually specializes in bond and bond-like instruments to get your income up. Keep in mind, we're talking about inflation here. Inflation is all about getting your cash flow up. Your cash flow needs to exceed your expenses. And if your cash flow has to come, if you increase your cash flow and it's coming from your principal, that's not good news. That's why the sequence of inflation risk is a problem. And sometimes it goes unnoticed for a little while. And, short-term plans, pretty much, it doesn't matter what kind of retirement plan you have, it's going to work out. It's where the problem persists is when it's like cancer. It gets bigger and bigger and gets worse over time. And so you want to be able to make sure that you're prepared for understanding, especially the difference and the distinction between bond versus bond funds. And this commission report will help you to know the difference. You see, bond funds pay income in different types of asset classes: municipal bonds, corporate bonds, or government bonds. Government bonds are more guaranteed. I'm talking about the 10-year T-bill, the 15-year T-bill, or 2-year or 30-year. In other words, the longer the term, the more risk that you could be taken, because a return, if you get 4% today, that's probably not going to keep up with inflation in the long run. So you want to be able to get a specialist that knows how to be able to keep income up while simultaneously being able to beat inflation. But most importantly, to beat inflation, you got to get the income up. If it's coming from principal, you're not beating inflation. You're conning yourself if you think you are. But see, you can either use a diversified portfolio like bond funds, which is what they are. They're more diversified. Or you can use a diversified of custom portfolio where it's more individual bond and bond-like instruments. You see, a bond fund, you essentially own the stock company that actually owns those bonds. As a result, you don't have any contractual guarantees, as you do if you have things like individual bonds and other bond-like instruments. Plus, you got to realize that bond funds have certain risks, like drawbacks, because of being a mutual fund. What are some of these drawbacks, you may ask? Well, let's start with cost. Typically, mutual funds have higher management fees that are embedded within that fund. And those fees can be a lot higher than even what the forecasted expense fee that they're actually showing. Because you also are going to have to pay an advisor to actually sell you those particular bond funds. And whether you pay that up front or it's amortized over the so many years that you hold the bond fund. So if you're paying a fee or a commission to an advisor and the fund manager, all these fees are assessed regardless of how the fund performs. And so if the fund, first of all, is not paying the income you need, even though you may be reducing your risk, you may need the income also in addition to. Why not? What a novel idea to have income increase in an instrument that you're trying to reduce risk. Why not also get a return of your principal? That's why we advocate that real bonds managed by a specialist is going to be by far better and superior to having bonds that are inside of mutual funds or exchange traded funds. So if you want to learn more about income first methods, in other words, your transition and in retirement, and why is it important to be able to focus on income first, growth second, you'll get both. But it's very difficult to get both because growth is the unknown. And I got a great book I like for you to actually call in on called Return on Principal, authored by CFA. That's a certified financial analyst, Dave Scranton. And I got a free copy for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail this out to you if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. You're listening to the Retirement Income Source. Tim Sparks. I'll be right back. Welcome to the Retirement Income Source. I'm Tim Sparks, and our show is sponsored by Sparks Financial Group, a firm right here in the heart of Bluegrass, Lexington, Kentucky. Today we are actually talking about 4 risks you can't ignore. And I talked a little bit earlier about bonds versus bond funds, which is one of the key risks, and what they're talking about is the sequence of risk. And the sequence of bond risk is simple. Yields have been actually low historically in the last 20 years. And so what the white paper is actually doing, this is written by an academician, is basically saying the yields are much lower. So in other words, if somebody's taking out 4% or more out of their portfolio, they're running even more risk because of that fine that they noticed. And what they were examining was primarily bond funds, because the bond funds pay a certain amount of income, but they don't pay enough income. And so, with that being said, that means as interest rates fluctuate like they did in 2022 and 23, and part of already going into this year, rates are still up. That means the fund values are actually down still. So what they're saying is, since the yield if you had $1 million in a bond fund today, it's only going to pay you like $30,000 a year. If you subtract 1%, because you got a financial advisor keeping you at low risk, that means your fee is going to be $10,000. So you're really only netting $20,000 a year in income. And here's the sad thing about it is that's the reason why you're getting $20,000 currently is because interest rates are up. Well, and that's what they were saying in this report. Over the last 20 years, rates have been down more than they've been up. We all know that. CDs have been historically down for quite a long time. We used to call them certificates of disappointment, and a lot of that reason why is because when your rates are down, and of course, mortgage rates was great, borrowing rates were low at one time. So as everything goes up, as the tides go up, so does the yield. But once that rate goes down, then your income in that portfolio is also going down, and that's what they're saying. Because even in the report, it's saying the people are actually taking out 4%. That means they're spending principal, and if rates go up, you got the inverted relationship of the bond fund. So the value of those funds are down. They actually went down as much as 20% just about a year and a half ago, and they're still down right now. So you can imagine you're trying to reduce risk in bond funds. You can have the best quality of bond funds, and taking out 4% of that part of your portfolio, you're actually spending your principal by taking low risk. And so basically the report was saying that if you have to get the yield up in order to benefit you from a sequence perspective. In order to do that, you got to be able to have individual bonds and bond-like instruments that pay a higher income. Therefore, you don't need to actually take principal whatsoever. And so right now, our clients are enjoying a 4 to 6% yields just on their bonds. And they're doing that because we have a specialist that specializes in those particular securities. And one thing I have found is most advisors don't want to deal with individual bonds, which means they're going to have to put on their payroll a specific analyst to be able to do that kind of homework. And believe it or not, that's not easy to do. Not only is it not easy to do, it also costs a lot to be able to have that analyst on board to be able to do that type of assessment and that type of analyzing, because there's a lot of work that goes in to be able to put people in those type of instruments, so that way they can rely on that income. And not only that, people want their portfolio watched after every day. So that way they want to know that income is going to flow in, and they're in the right instruments for the current economic trends. And to be quite frank, I actually know that's going on right now. I mean, I did a review here recently with a client that, they're like 55 years old, and he doesn't need a lot of income, but he sold his business, and he's got like $500,000, and he says, can I get at least, 25,000 a year, roughly 2,000 a month? And so when we did his recent quarterly review, his $500,000 is still worth around $540,000 or $550,000, and he's doing that by using more of a moderate like type portfolio. Moderate means middle of the road. Now think about that for a moment. You start off with $500,000, it's worth $550,000. The bonds, paper losses, and the preferreds have still not come back to their normal value. Once they do, the value of that portfolio could easily jump up another $30,000 or $40,000. How would you like to be kind of somewhat conservatively, moderately invested in a way, and still be able to maintain your principal while same time taking out equivalent to what is maybe a 5% net return? I don't know about you. I mean, if I need dependable income, I want income that's coming from the right component, that is from the interest and the dividends. That way I don't have to worry about market fluctuations. So if that makes sense to you, I got a commission report I like to get in your hand talking about the universe of those income strategies that actually offer that type of income, so that way you can learn more about those. And I got this commission report can be yours, and I can email or mail it, whichever you prefer, if you call 888-930-1080. Again, that's 888-930-1080. And we'll mail this out to you again, or email it to you. Again, call 888-930-1080. And again, that is, remember, you got a problem in retirement. You need income. To get income, that means you're going to need the tools that's going to pay you income. That's assuming you don't want to spend principal early on in your retirement years. You're tuned in to the Retirement Income Source. I'm Tim Sparks, and we're talking about 4 risks you can't ignore. And I've been talking a lot about bond versus bond funds. And the distinct difference between those two is as different as apples are to oranges. And so the question is, you better hope your advisor is preparing you for this particular type of risk. It's not just the risk of you leaving money on table. It's because the type of tools you're using are historically have had lower returns, which means if you're trying to avoid running out of money before you run out of breath, then those tools are probably not going to get you through retirement like you hoped. So I want to put a little bit of time into equities, and equities meaning individual stocks, and the sequence of equities risk is extremely important, because if you're going into retirement, it matters whether the markets are trending upward or trending downward while you're taking withdrawals. You see, we invest our clients for equities, but they're paying enough dividends that way they don't have to worry about the fluctuation of the market. But since most people that are tuned into this show right now, you probably got your money in mutual funds or exchange traded funds, maybe even paying a fee or not a fee if you have your 401ks or you're trying to do it on your own. But you got to pay close attention to the sequence of equity risk. And that's actually probably the most important one of them all. Because if we have a 1990 to 1999 market, you have nothing to worry about. Did you know for those 10 straight years, there was only 2 years that there was negative years? A 6.5% year negative year, and I'm talking about a calendar year here. And I'm sitting here and I'm looking at this spreadsheet of the S&P 500, and that's assuming you take out 5% withdrawal rate. Your $1 million would still be worth $2.7 million by the time you got to 1999. So in other words, you grew 1.7 million because the equities favored you. In other words, you got lucky, the markets went upward in that trend. So the sequence of equities actually favored you. So you're just taking out withdrawals that, yes, you're spending principal, throwing caution to the wind, but it worked in your favor. So in other words, when you go into retirement, do you feel lucky? It wasn't the case for another client if they was to retire in the year 2000 to 2009, the lost decade. Because if you remember the dot-com bubble, 9/11, etc., for 3 straight years the market dropped basically almost 50%. So your $1 million by the time you got to end of 2002 was already less than $500,000. So to add insult to injury, even though we had 5 good recovery years of 100% cumulative return, the damage was already done right out of the gate, and by the time 2008 came in, another 60% loss top to bottom, 2007, 2009. Now you're down to $286,000. So in other words, 2 different results. One very dramatic, one you wind up getting lucky because the markets favored you. And so when you go into retirement, you don't know which one of these are going to affect you. It all depends on how the markets lay. So if you're one of those that are kind of, you're an optimist and you want to be in the market because you like the idea, and so do I. I agree with you. If you're one of these people, you want to deal with individual stocks versus stock funds or stock ETFs, and you want to be able to get some returns on your money so you can keep up with inflation. I get it. But you do that by investing for dividends instead. And so it doesn't matter whether you invest for dividends, or even if you want to reduce your risk, you may want to have some bonds or bond-like instruments. But most people want to be able to have an inflationary hedge, and to do that, you got to have individual stocks, because that way, if the markets do wind up going up in an upward trend, you're getting a dividend plus growth at the same time. Therefore, you can kill 2 birds with 1 stone. But if the flip side was to happen, I'm talking about a solution here. You're still one of those that want to stay in the stock market and paying dividends, and then you was to run into the other scenario where the portfolio dropped to $286,000. That's because somebody was spending principal at the rate of 9% a year versus 4% when they first started out in retirement starting in year 2000. Then if you was to invest for dividends, your portfolio, all you would have spent was the dividends that was paid to you. Yes, your balance would have been down, but your balance would have decreased to $400,000 to $500,000. Yes, it's cut in half, but you didn't sell shares. The person that's focusing on growth, that's what I've been trying to share with you with equities, because most people are focused on growth and less on dividends. The problem persists and it's actually worse. So you wind up cannibalizing your principal, where if you were just spending the dividends, by the time the markets actually did rebound, which they did by 2013, you would still have your money intact. And between 2013 till now, the markets jumped up almost 300%. Imagine all you're doing is spending dividends. And now that's for somebody that likes to, assume that markets are going to go up, but you want to be able to have some more defense in your portfolio, and you do that by using a dividend strategy. So if you want to know more about dividend strategies and income first methods, I want to get a book in your hand called Return on Principle, authored by CFA Dave Scranton. And I got a free copy for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. We'll mail it out to you. Again, if you're one of the first 5 callers, free, no obligation book, 888-930-1080. You're tuned in to the Retirement Income Source of Tim Sparks. I'll be right back. Welcome to the Retirement Income Source of Tim Sparks, your host, and our show is sponsored by Sparks Financial Group, a firm right here in the heart of the Bluegrass, Lexington, Kentucky. Today we're talking about 4 risks that you cannot ignore or you hope you are prepared for, because nobody knows what is going to happen in the future. And the type of risks that you or your financial advisor should be preparing you for are equities, equity risk. In other words, is there going to be a sequence of positive returns or negative returns when you step into retirement? Bond yields historically in the last 20 years have been lower. So in other words, there's a sequence of bond risk. Inflation. What if we continue to have rising inflation? That's a problem, because you're taking out income, people, at the rate of 3% per year increases. Got to keep in mind when analyses are done, and these are done very analytically. I'm just sharing with you, trying to give you the Reader's Digest version of how these reports are generated and so forth. And these risks are concerning. And so what we do to mitigate risk is we invest for income. And if we invest for income, all we're doing is increasing our mileage on our money or increasing our batting average. And of course, what compounds the problem is longevity. The longer you live, the more that these sequences of returns are going to occur. Because after all, you don't want to run out of money before you run out of breath. And the most fearful thing could happen to anybody in retirement is get 15 to 20 years down the road and start to drastically change their retirement plan for the worse. And it winds up being one that you wind up dreading versus one that you envisioned because you prepared for it or your advisor prepared you for it. So these are questions that you should be asking. And by the way, people, when you ask questions about these sequence of returns and stuff, you got to make sure you understand that answers can sometimes be flippant. I mean, if the question's not thought about for a moment, I've had accountants sometimes, and this is not anything against accountants, that have basically told their clients that they work with that they shouldn't do raw conversions, and the only reason why is because, and when I say flippant, they just basically said, I don't believe in them, without any kind of calculated reason why, or if they sat down and seen if it was in their best interest or maybe in the future. And of course, I'm just talking about being flippant here, and sometimes people will go and ask people, maybe even accountants or best friends or people that are maybe successful investors, and we kind of ask questions, and then sometimes the answers, if we're not careful, can be flippant, including financial advisors, because if they don't specialize in investing for income, and they really don't know exactly, because see, this show, the point of it is to help people to understand investing for income gets more mileage out of one's money. And I don't guess at that. That's not something that I just dreamed up overnight. That's something that I actually see each and every day. So I want to get a commission report in your hand called The 7 Risks to Your Retirement. It expounds on some of the things that we're talking about today. And this commission report can be yours if you call 888-930-1080, again, that's 888-930-1080, and we'll mail it or email it, whichever you prefer. These commission reports we offer are very short reads, but they're also very powerful at the same time and have a lot of impact. That number again is 888-930-1080. You're tuned in to the Retirement Income Source with Tim Sparks, and today we're talking about 4 risks that you can't ignore. You got equity risk, you got the sequence of bond risk, you got the sequence of inflation risk, which, by the way, we're still currently in that era at the very moment, which was kind of compared to 1966 to 1982. And then you got longevity. We don't know how long we're going to live. So as I pulled out my actuarial tables on longevity, a male is, if you're 65 years old, you got a 50% chance of making it to age 85. What they're saying is 50 make it to age 85, 50% make it past age 85. A female is 62% chance. To make it to age 90 is a 30% chance for a male and 42% chance for a female. So again, we don't know how long we're going to live, and you got to be very careful in even how you assess your own health issues that you may be already having currently. I have a father-in-law that has had open heart surgery, 4-way bypass back in 2001, and he was given maybe 5 to 7 more years to live. And today is 2024, and this guy is still alive. And the reason why is because of modern medicine and also his willingness to fight. I haven't met anybody that wants, that's looking forward to dying. So, as I read one time, we either get busy living or get busy dying. Most of us want to live and be able to enjoy things while we can. I'm not downplaying health issues, but at the same time, we have to be very careful. And so that means the longer we live, that means that the types of risks that you're going to run into, and inflation is one of the most serious ones that I see today. So I always like to share with you a story. I've already shared with you a successful story, but I'm going to share with you a story of somebody that's been in retirement about 4 years, a couple. They're both been in retirement for 4 years. They got about $2 million. They put all their money with a particular financial advisor group here locally in Lexington, and they're currently taking out $80,000 a year from their portfolio. And so, as I've done some research in their portfolio looks very similar to most that I see, primarily made up of mutual funds. Yes, they had their risk reduced, but their risk was reduced by having about 45% in bond funds and 55% was in equities. So, what they were wanting to know was how much income they were getting. So we did a retirement risk report where we covered how much risk they're willing to take now going forward, and at the same time, how much income they're currently getting from the burden of hand. Well, as we did the report, the amount of income that they're getting from their mutual funds was about $28,000 a year. That's net to them after all fees. Now, that's not too bad, with the exception that they're spending over $50,000 a year in principal. Now, with them having $2 million, that most would think, well, that's quite a bit of money. I don't think them people are ever going to run out of money. Well, that may be true, but again, if they have any kind of sequence of risk where equities actually turn for the worse, then they're going to be spending more principal because they're having to sell more shares in a down market. Their bond funds are not going to be able to benefit them any. And not only that, if they have to raise their income, which they are going to have to increase their income in a couple years, and plus they got required minimum distributions they'll have to be challenged with when they turn 73. So yes, when you're taking that income and you have to increase it because inflation's forcing you to increase it, then you're just spending more and more principal. And so that was one of the things that was concerning to them. So what we basically did showed them that they can get anywhere between 85 to 100,000 a year in dividends. Therefore, they're getting it from all the interest dividends, and therefore they can take out 80,000 from the appropriate place. And all of that, they can still have an inflation hedge because we had more they had a surplus, and that surplus gets reinvested and gets to buy them more shares. So organically, in a way, they can buy shares while they're still in retirement, which is what they were doing when they helped them accumulate wealth originally, when they were contributing and their employer were contributing. So interest and dividends play several roles, not just one for income. So if you want to learn more about income first methods that make more sense for retirement, I want to let you know about an excellent book called Return on Principle, authored by CFA Dave Scranton. You see, if you have a strategy geared toward interest and dividends, you always know how much income you're going to be getting. So now it doesn't matter if the markets go up or down. That's extremely important. How would that make you feel in retirement, knowing where the income's coming from? Just like a renter that pays income to a landlord, they still own their real estate. You see, if market fluctuates, it increases our stress levels, especially if we're spending principal. So knowing how to invest for the I first will reduce your stress, and therefore you're not having to hope every year of getting growth. And I got a free copy for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail this book out to you if you're one of the first 5 callers. Free, no obligation book, 888-930-1080. We thank you for listening to our show today. We hope that the show has been beneficial about the 4 different types of risk that you cannot ignore. We look forward to another great show next week to help you to be able to sustain a stress-free retirement. Thank you for listening. This is Tim Sparks. We'll see you again next week.